Okay, good evening, gentlemen. Clueless Day Trading, Frank here. We're having a quick but important free market update webinar on the first day of trading after the Brexit week, as well as after Independence Day, July 4th weekend. This is July 5th, 2016. Approximately 7:07 p.m. Eastern Standard Time. Session is being recorded. Will be uploaded to the Clueless Day Trading YouTube channel. That's accessible to anyone for just going in there and subscribing. Just putting their email in there so they get notified anytime I put any free stuff, specifically video casts up there. So you can go tell your friends to do that too, so they can start to get a little feel of some of the things that are forecasted and spoken about and discussed in our community. Full disclosure, this is purely for financial education and not for any solicitation or advice. Okay, this is the first day we're having a open live webinar after the huge, monstrous Brexit reversal that took place last week. Obviously, things get very hectic. Time-wise, it gets very time-consuming. And with the holiday weekend approaching and stuff, it just wasn't physically possible for me to do the advanced coaching sessions and such on a holiday weekend. But I'll be resuming that in full blast starting this week, specifically starting over the weekend. I intend to start having the advanced coaching sessions early on Saturday morning, so we don't always have to wait till Sunday evening, which sometimes gets delayed for obvious reasons in the summer. So I'll be obviously posting those times, and members who have paid for the sessions can certainly attend those. This is open to anyone, so feel free to join it, and let's start off. All right. First and foremost, there are a lot of things that we can talk about, but we don't have time to do that. What we're going to try to do is to nail down the most important points about financial markets, behavioral economics, and ourselves. Because what happened last week was just incredible. But it wasn't that incredible in the sense that if you listen to the previous video cast on what I was expecting to happen, not only did that happen, it went beyond that. It just seems to be every single time that I'm doing my projections and my forecasting, which come correct, instead of being 100% correct, they become 120% correct. Because the force and momentum of these type of powerful short covering moves after what seemed like we were going to go a little bit lower. If you have listened to my previous videocast, I expected the market to hit around 1950. However, when I did not see it break the 1990 level, or more like 1980 on the pre-market basis, as a half-intelligent trader and a pretty successful one, I'm not going to sit there trying to make the market listen to my wishes. I'm going to adapt, and that's exactly what we did. And the results were absolutely enormous. And people who basically took advantage of that, and many of you did, I know. There are testimonials some have posted on what they have done. Many have told me personally, have been fantastic. It's not like you have to catch the entire wave. If you caught the entire wave, you'd have made $1 million. I'm not exaggerating. Okay? But the reality of the thing is that that's not what people do. People crouch in fear, despite some very powerful technicals that are showing that the market is going to move, just the way it's showing it again. But they crouch, they do stupid things. We all do. But some do stupid things more than other people. And that stupidity costs money. And it costs a lot of regret. And it costs loss of confidence. And nothing is more dangerous in this business of trading and investing than loss of confidence. Believe me, I know. Okay? And when you have a loss of confidence, it doesn't matter what you do. You are not going to make money. Period. It doesn't, and this has been seen even within our exclusive community here at Clueless A Trading, where fantastic trades have been put into place. Trade setups which are just phenomenal. Stocks that are runaway trains. Yet, the majority of a certain group of members just sat on there and did nothing. Now, this is not the first time this has happened. This has happened repeatedly. So my suggestion, helpful suggestion, as you know, I only try to help. I have nothing to gain from other people's misery. Okay? Is that you need to practice behavioral modification. If you think that I'm kidding around, let me just enlighten you. I am not kidding around. I am being dead serious. If you don't behaviorally modify your old habits and the same old little excuses that you keep on giving your little brain, you will never get anywhere with trading the stock markets or financial success in this particular field. You might be very, very successful, many of you, in your fields. Okay? Very successful in your fields. Whether it be in high technology, whether it be in administrative stuff, in engineering, doctors. But when it comes to this game of behavioral game theory, that's really what the stock market's all about. People are pathetically huge failures. I started noticing this years ago back on Wall Street, when I started to realize what this whole money management, this money game was all about. It took me years to understand, but I'm a fast learner. And I'm a fast adapter. You have to be flexible. If you're rigid, you're finished. If you don't want to adapt to this new paradigm of robotic, algorithmic, high-frequency trading, the way these charts work, look at this chart behind you. It looks like a frigging it is. It is a mathematical manifestation of human behavior. Every single candle, down or up, tells a story about yourself. Why you did not buy into the ramp. Why you sat here thinking, oh Lord, I can't believe I missed all this when I could have bought that stock 70% lower. I'm sorry, what 70%? On the options, 400% lower, and it still got 200% more to go. But at that point, the monkey on your back has grabbed you so hard that you can't even move your hands. That's called behavioral finance. When that monkey gets into you and you're so scared to make any move or selling too early, one of the worst quotes in the financial world, okay? Financial world is, well, at least I took a profit. That's complete bullshit. At least I took a profit. You got stocks that are being given, which are running, the calls are running 1,000%. You think I'm making this up? It's all there. And you're taking 30% of that and you're saying, at least I took a profit? Hey, look, I want to slap myself sometimes too. Especially, I've said before, that when it comes to holding too large a position, human beings, just in general, and traders included, tend to do stupid things. They tend to bail out early because all of a sudden, on a 3-point move on the S&P, they were up a couple of grand. They're like, oh my God, gotta go. That gotta go cost them another 30,000 they could have made if they had stuck to what I've shown repeatedly through my constant engagement with my members, through my Periscope broadcast, through my Clueless 8 YouTube videocast, through my precision charts. If you even followed 40% of it, 40% of it. Forget about really following it from A to Z. You could have been a fundamentally different trader right now as you're listening to this videocast. This applies to every one of you. It applies to me. My numbers are bigger. I do not exaggerate when I say that if I followed every single little thing that I show and I share for a puny little amount of money every single month, okay? And that is puny for the amount of performance that I give. And I will say that, okay? Making 7 figures a month is a breeze with not hundreds of thousands of dollars of trading capital thrown in. Half of that type of trading capital can generate those type of profits. Do the math. You got a $5 calculator on your table? Grab it. Multiply 200%, 300%. Do it on an exponential basis on a $10,000 investment. And you tell me where you arrive 3 weeks, or from 3 weeks to now, or till last Friday. You tell me. Just do an exponential, factor. 10,000 to 30,000. That's 200%. 30,000. I'm not saying it's that easy. Yeah, in paper, everything's easy. Like I say, paper trading's garbage. Yeah, it's good for little real amateurs who have no idea about trading. But when somebody wants to paper trade on the side, the reason I say garbage is very simple. Many people won't agree with me. Who cares? It's garbage because there's no emotions involved. On a paper, you can buy and sell like as if it's just pure numbers. But it's not just numbers, ladies and gentlemen. It's your mind at work, which is constantly, in many cases, screwing you up. So if you don't have skin in the game, like they say, what is paper trading going to do for you? Yes, it's good practice. I have no doubt about it. But practice doesn't land greenbacks in your bank account. Practice lands greenbacks, dollar bills, $100 bills in your bank account, stashes of them, if you engage in the battle that we call trading. Or investing, for that matter. That's a battle too. So what I'm getting at, and I want to keep on harping on this, all right? It's extremely important. And I thought about it over the weekend. I had a lot of stuff going on. I was a little bit under the weather. I'm still a little bit under the weather, but everything's good. But the point is that I thought about this, that the amount of money that was forecasted and charts that were given and stocks like whether it be Priceline or Amazon or Netflix or even Tesla, not to mention so many others, which got up and started running in the middle of the crash. We got a puny little stock that I trade time to time, BSPM, up 50% intraday. So there's a lot of things going on, a lot of moving parts. But I'm noticing that many of you are just making excuses. Now you can live with your excuses because it's not my problem. But as part of my service, as I said, we have a component of my service, and there are some new members here, and welcome, Nav and Rocky. Is that part of my service has to do with trying to share with what I think about every single day, the behavioral modifications that I try to change about myself, and move on to sharing that with others so others can hopefully get the same type of motivation. So that's it. Now let's get straight into the technical part of the business, okay? As to what we might think is going on. Some of the new members, appreciate you mentioning that. Nav said that over the weekend. He tweeted to me. And by the way, I don't really use the tweet as a communications medium, so you can certainly do that time to time. But do stick to the chat room, or if you have a specific question, you can email or PM on the chat room, things like that. So bottom line is that he mentioned that, he saw the video cast and he said, oh my God, these things were just amazingly precise, because he's new. He's here today, Nav. So many of you already know that, but maybe don't feel it as much as somebody new coming in and saying, whoa, this guy talked about all this stuff before, and it actually happened like that. And so they're far more impressed than maybe some of the older members who tend to be a little bit more, what's the word I'm looking for? Apathetic, maybe because they're not really quite getting it. They need to wake up. That's the bottom line. So let's get straight to what I'm seeing here, and this is a simplistic way of looking at the markets here. So what you see here in the background, obviously, is the whole Brexit stuff, right? And then the recovery, and that was a powerful recovery. Now, one of the reasons why that happened, that they'll never talk about here on the media or anything, and I've mentioned this a few times. You don't get a recovery of this magnitude just off the blue. A couple of things happen. There was some large hedge funds, including Soros's and Carl Icahn and others around the world, who were heavy short the market. And they were getting hurt because the market was trending higher. So when Brexit happened, for whatever reason, this was a lottery ticket for them. The market dropped roughly 900 points in 2 days, right? The market dropped 900 points in 2 days between Friday and Monday. So when you have a 900 point drop in the market in less than 16 physical trading hours, and of course I showed the live video of the market crashing during that Brexit night, Thursday night, all that stuff. It's all there on the YouTube channel. So when you got that, it was just unheard of. For them, this was the time to bail, meaning cover the shorts. And that's exactly what they did. You're talking about billions and billions of dollars worth of notional shorts. Somebody had floated a number of $9 trillion worth of derivative shorts that were placed in the market and needed a way out. Well, think about it logically. This was the way out. I did point out that we would find if we when we stopped going down on Monday, and I won't get into that right now because it's all there. You guys can review it, and also review the review on the Twitter feed what I was saying and doing. Well, you got a double bottom formation here, and I did say very clearly that the biggest money is made in the next 24 to 48, and honestly speaking, between in the following 24 to 48 hours. Well, that's generally the case, except I was wrong, because the market it was unprecedented. Between these trillions of dollars worth of shorts covering here, between, I'm sure, the invisible hand of the central banks, not ours necessarily, but the European ones who had much more to lose. Okay, it could be the European Central Bank too. A significant amount of money went into the markets, hard. And all of a sudden, it just was a complete ramp up. Now, what happens during these ramp ups, just so you all know, I'm sure you guys have felt it too, is the fact that most people fail to participate because they are so even if they got hurt a bit here, maybe they didn't have that long a position. And I want to point out that I did tell people straight out that this was the point of exit for majority of the longs. Of course, a few longs were in place because it hit exactly the mark that I was talking about 4 weeks ago, this pattern symmetry of the markets. So once it hit there on that Thursday afternoon, and I had to run out for my son's graduation, I also said put in a few hedges out there. Well, those hedges were like lottery tickets, and we all wish that we had a lot more. But the fact is, that even despite this, so you had this unbelievable move, complete capitulation on many different funds, a 10-to-1 down day, which is huge. That means 10 stocks down for every one up. Those are real capitulation type of things, 9-to-1 or 10-to-1. On both sides, if you get a 10-to-1 up day, that means the market's basically at that point exhausted. It's a topping process. And if you have a 10-to-1 down day, that means major capitulation. Standard stuff. Like, it's just forced selling across the board. So then you have this. So when you have this type of move here, what generally happens is people don't get in. Okay? People don't get in. Multiple opportunities to get in. Indicators showing crossovers. This is very powerful. When the orange line, the 34-day moving average. In this case, it's a 1-hour chart, but still, this is serious. Okay? Went down from a cross under to a crossover in a matter of 48 hours. 72 hours. So you have a 34 crossover over the 50. Very positive. Very. I said it before that when markets get overbought, it's not like they're always going to correct right away. In a powerful uptrending surging market, because every single time the market had this little red candle, shorts covered. So that's the reason why you had this surge. These are buying surges. It started off here, boom, minor consolidation, boom, gap open, minor consolidation, bang, bang, bang. It's just like you can't get away from anything. You try to short the market, forget it, it's over. But you don't want to be shorting the market when you have the RSI or the derivative of the RSI, the stochastics in this particular case, clearly trading above 75 and not willing to break down. So you don't want to mess around with that. Just remember that. Same thing with the stock. Don't stand in front of an oncoming train like a lot of people try to do when they were trying to act like heroes when Priceline was moving and we picked it up at the lows. 40, 50 bucks on Priceline every day. People are like, oh my God. Oh my God, what? It's 1.5%, maybe 2%. A 2% day on Priceline is $26 or $27. So what's the big deal? It's not like it's up 10%. A 10% the price line is $127, just the way when it fell, right? So the bottom line is that look at the percentages on certain stocks. Not always just look at the prices. The prices can be misleading. A $5 stock goes up $1, that's 20%. A $50 stock goes up $1, it's 2%. It's the law of numbers. So anyway, so you had this here within, and there were other fundamental reasons too. This Brexit thing is very complicated. And it's not always complicated in a negative way, mind you. This could be the best thing that happened to Europe in a long time, and to England. And I did post some very important articles for people to read, especially the speech by George Soros, which pretty much, in my opinion, sparked the rally, because he indicated that this was the kick in the kick in the behind that Europe needed in order to wake up. And believe me, that guy knows. He made money on the short side, and I bet your butt he went long. And he's got, what, 30 billion to play with? He can move countries. So the bottom line is now he's very supportive. He doesn't want to break up Europe. I mean, like destroy Europe. He did a tactical short. He made another fortune. I don't know why he needs a fortune. He's freaking 90 years old. But it's the game, right? These are warriors. They like the challenge. So anyway, so you had this massive move. You had, on a technical basis, you had these crossover, very positive. And on Friday, I did say, put out a few hedges out there, because I do expect to pull back. That's exactly what happened. If you look back at my, and some of the newer members like Nav and Rocky have actually started to look back at my charts. In fact, they're looking at the charts a heck of a lot better than a lot of current members, I'll be honest with you. I'm very impressed, really. Because that's how you measure whether or not I'm full of shit or if I know what the heck I'm doing. I'm not just, I'm not like some, just because I give one trade and it goes up like 30% in 2 minutes, I'm a genius, right? No. It's forecasting these markets in these extremely crucial and difficult times when none of the bozos that are paid millions of dollars sitting there in the media telling you what to do, or your local broker or your advisor or your guru guy that you follow, who are consistently wrong. That's what makes me do, makes the credibility of the service worth it. So I'm very impressed that you guys are actually looking back at those reference points, all right? So I said on Friday, look, we're going to pull back, reduce your large profits, all that. Top-notch, top-shelf suggestions. And that's exactly what we did. So it looked like, oh my God, now we're going to just fall apart. No, this is simply so far. We got to go with what I'm seeing, all right? And I'll validate by looking at some of the basic internals like I do. Keep it simple, stupid, right? The KISS principle. So you had a consolidation channel. I put that chart out there. I had a couple of things going on the family side, so I came in a little bit later. All right, so I had to get myself on the hot seat and get back in the mode. So this looked like either, and I said that on the Periscope broadcast, either we're going to come down, we could do that even tomorrow. Test the 50 moving average around 2060, or we stick within this consolidation channel and try to break out. Try to break out. Generally, consolidation channels, if they do want to break out, they break out. And if they break out, you're going to test to 2110 again, if not 2120. My gut is telling me this market wants to go higher. It wants to once and for all take out this 2120, 2134 level and just say a big, to the hardcore shorts and say, we can do it. And at that point, they start to get frothy. All right. So what validates my point that this is a possible breakout as we get into the latter part of the week? This is quite simple. What we're seeing here is a minor basing pattern of an overbought condition down to oversold condition, and now we're starting to creep up. As long as these lines, and I've been saying this for a long, long time, and people who just follow this basic stuff have managed to keep within a trade, stay with that trade, and do extremely well. Because if you don't follow the internals and simply look at the prices in front of you, and I'm just giving you some basic thing, I'm not going into the hardcore analysis here. Those are for the coaching sessions, all right? But if you just look at the prices and not look at the internals, whether it be the histograms or whether it be the simplest one to look at, which gives you the best directional indicator, the STOs, the stochastics, this is the fast stochastics in this case, then you're doing yourself the biggest disservice ever. Can't just look at prices. Prices overall mean nothing because they move around like a little monkey on a hot tin roof so fast that it doesn't matter. 1 minute up 5, next minute they're down 3. Haven't we gone through this so many times to know this? Yet traders fail to look at the internals. You got to do what you got to do. You got to do the right thing. Can't be doing the dumb things over and over and over again and then blame everyone else for it. Oh, I don't know how to recharge. Oh, I don't know how to do this. Well, then don't do it. Just go away. All right? Seriously. So here, what we have here is a nice basing pattern. I like what I see so far. So the bottom line is that we have a movement up, and if it starts to keep on going up on the 1 hour basis, as you know, this is the 1 hour chart, these reset real fast. They reset up and down real fast, right? Here it didn't, here it basically the whole week. Well, this week also had to do with a lot of end of the quarter window dressing, fund managers basically salivating and drooling over prices that were down at one page, in some cases 10, 15%. They were just like, let me grab this, let me grab this, let me just grab this, and tons of money came into the market. So window dressing, end of the quarter, all kinds of stuff. And then the short covering, those were the three main reasons why, markets went up. So at this point, as long as you see these toes, real simple. Keep on doing what they're doing, which is creeping up. In between, they're not going to go to a straight line. They might zigzag around a little bit. But as long as the general direction is higher, that means the market wants to do this trajectory. That's it. It's really simple as that. Now, if you look at the overall picture of these rising wedges and falling wedges, you can clearly see what's going on. A rising wedge has a consolidation. This is the consolidation. If the market doesn't want to break down, there is a gap here. You can see that. And that gap is around 2030, 2040. Is it possible that it gets filled? Absolutely possible. So then the pattern becomes like this. And everyone starts freaking out again. Not to freak out. Because this was the breakaway. This was also the large V-shape, what do you call it, the dragon bullish pattern, which I identified. This was the breakout of the dragon bullish right around the 2030, between 2020 and 2030. So is it possible that it comes and retests that? Absolutely. Is it possible that the market will basically fall below this consolidation channel and come down? Where did we close that? 2080? Well, it caught a bit of a drop. 2080 to 2040, so you're talking about 2088. So 50 points, let's say. So they're talking about 350 points or so on the Dow. Look, anything can happen. It's a low probability event, but it's possible. So let's say we fall 350 points. That's what it is on the Dow here. Then that creates another possible floor, testing this, refilling this gap, retesting this gap for the market to do this. Is it possible that the market does this all the way down here? That's a low probability event, but it's there. But it's there. Maybe not as quickly as we think it will. Maybe not in the month of July. It could do that in the month of September again. And in this case, it might break below the 1990 and go test at 1800s again. That's a possibility. I still think the big drop comes in the month of September and October. As the election jitters hit the market full force and maybe, some other macroeconomic fallouts of this Brexit referendum, maybe another country, in Europe, which suffers another banking crisis, anything can happen. Anything can happen. So what I'm getting at is at this point, this scenario one is we are going to do this. And why is all this important? All this is important because there's a lot of you stay in a trade or get the hell out and do stupid things like, most retail traders normally do. So that's the only reason why I'm explaining the background, okay? So I used to call this the galloping horse in the old days, just make it up. So if you look at it, it looks like that, right? So the best case scenario for the bulls would be that we consolidate, maybe pull back a little bit on the consolidation channel down here again. But as long as we hold this consolidation channel overall, the trajectory of the lines need to basically tilt upwards. That's important. Because what are moving averages? They're supports of prices over a period of time. So we don't want to be like breaking well below the moving average down here or something like that. We need to basically stay close to the moving averages. Because once you overshoot the moving averages, as you all know, many of you know, you revert back to the mean. It's called mean reversion. We fell completely. This crash was probably a standard deviation of 9 or so from here, from the moving averages down to where we went. So it reverted back to the mean, except didn't stop. It just went straight out. So if this was -9, then the standard deviation from the moving averages to here is possibly a +5 right now. So it had to reset. Things got overbought. So for the longs, the best case scenario is that we stick within this consolidation channel and then we attempt another breakout. Or if we slip, we better hold this 50-day moving average that I showed. That's around 2060. Call it 2060, 2065. You break below that, there's a gap here to be filled. Not necessarily good, but not necessarily bad. However, anything below the gap, let's call it below 2040 or 2030, is going to bring in some heavy-duty selling, which means that we would most probably go back and test 1990 again. So that's really the simplest way now. One way to figure out a little bit about what's going on, because markets are very fluid right now. Patterns can change rather quickly. And I've noticed that on my algo HFT charts. All right, is that if this, I'm going to be watching this, and you guys can watch this too, to see what's going on the 1 hour charts. Now 1 hours move very fast and they can change directions. So let's take a good look at the daily to see what's going on. 1 hour looks like we're going to have a reversal, quick reversal rally, probably like I showed on my charts today, 2107. By that time we get overbought. If we decide to stay overbought, we have a chance to go to 2120. Those are pretty big moves. Those are pretty big moves for some of the high momentum stocks and stuff that we trade. So let's take a look at the dailies. So on the daily, it's a slightly different story. The dailies are telling us, let me take these lines out. So the dailies are telling us that we're overbought and it's crossing over a little bit. So an amateur will say, oh my God, it's crossing over. Now we're going to go all the way down and we're going to fall really hard. No, not really. Because there are other factors in play too, not just the stows. What's in play are these lines here. If you notice that despite this horrendous drop in the market and the 900 point drop and this total calamity that was supposed to, you know, come by, and it was pretty scary, the Brexit thing, the moving averages are still continuing to move sideways. It's pretty obvious. So what gives? If we're really going to go into a bear market, as some of the pundits on StockTwits and many other forums are telling us every single minute, okay, then why are the moving averages not cracking? And why is the overall breadth in the market at one of its strongest levels in many months? That actually tells me, and as one of the technicians on TV was talking about, our Ari Greenwald, he's pretty damn good, that you got to go with breadth. Because what it's telling you is that a lot of stocks are participating in this rally. And that's a good thing. So it gives you more ammo to break out of this range that we've been traveling in for a while now. Let's shorten the range. Let's call the range 2025 and 2120. Roughly 100 points, right? So this 100-point range that we're traveling in. Actually, I should broaden it a little bit. I like this better. Okay. So if we are traveling in this range here since beginning of the year, actually, since the February rally, you know, after we crashed in January, in case any of you forgot. So we're moving in this range here, heavy volatile range. Is it not possible that we do this again? But one way or the other, we are going to break out of this range. And if we continue to stay on the upper end, and this is something really important and real simple that you guys need to keep in mind, that if we stay above the 50 and the 34-day moving averages on the daily over a consistent period of time, or majority of the time, the market will gain enough momentum to break out. Believe it or not. What we need for the real breakout to happen are banks. Okay? And we need some real movement in the European banks that translate into movement on the US banks, and that's when the breakout happens. And by the time it happens, it's going to be too late. Because they'll just run, just go like crazy run. I like trading banks like the Goldman Sachs of the world, as you all know, on a tactical basis. They're way too volatile to hold for a good period of time, unless you pick them up at a decent price like we have done many times and ridden them for 6, 7, 8, 9, 10 points. But the consistent movements in the banks are very hard to predict because of the waves of issues from Europe that's coming our way. So as long as we stay above the 50 and the 34-day moving averages, or most of the times, let's say, okay? Remember, we fell, this was a 34-day moving average. This is where we were by Monday afternoon, right? Talk about a full-scale blowout. This was a massive, the distance traveled or the standard deviation from the moving average in the daily to here was huge. Like I said, it was probably a -9. Those are unheard of. So here, we just went back to here it's 0, right? Because reversion to the mean, we went back to moving average, and now we're here. So in order to replicate this -9 standard deviation move as a pattern symmetry, we need to go up here to +9 in order to validate the pattern symmetry. Because it's a law of nature. Every action has an equal and opposite reaction. Okay? So every action has an opposite and equal reaction. So if that's the case, then this, let's use this as the border, right? This is the border, right there, the moving averages. So we fell like this from here. So this distance, let's say, was like I said, let's call this distance X. Excuse me. So Y has to be equal. So in order for Y has to be equal, do the math. It was 2076 here. Okay.
Hey, Frank, are you showing something on the screen? Because all I see is the hourly screen and I don't see any movement on there. And you're showing some lines, it sounds like.
My screens are fine. Are people seeing? Maybe your screen hasn't refreshed yet. What happens is when I move into another screen, sometimes it takes a minute or so for your side to refresh. So others are seeing.
Okay.
The others are seeing the daily screen that I'm showing, right? The SPX.
Yes.
Yes, I can see.
Okay, so you got to Rocky, are you still?
Okay.
You need to.
Yeah, let me get this desktop version then, because I guess that's probably the problem.
That's probably the problem.
Sorry.
Okay. No problem. Yeah, because this happens like anytime I'm switching screens, it takes about a few seconds for you to refresh on the other side. In your case, you're still stuck on the previous screen. Okay, so he's going to fix it. Okay, so the bottom line is this x-axis from this distance. Okay, let's do the quick math here. 2076. What did we fall to? We fell to 1990, right? So to be exact, it's 86 points. So this distance traveled was 86 points, all right? Everyone follow me so far? Okay,
yes.
86 points, all right. So 86, I'm just putting P, all right. So you add 86 to 2076 in order to get exact pattern symmetry, you are going to get 2,162 on the S&P 500 in order to have a asymmetrical reaction bounce off the moving averages, because the moving averages are just moving sideways like a straight line. So if you add 86 points to 2076, which is sort of the starting line, you arrive at 2162. I can assure you, you are going to get 2162 either before the big drop in September, or it's at some point during the year between now and December, you're going to get 2162 on the S&P 500. Wouldn't be surprised one bit, because symmetries always replicate themselves. There's no question about it. So this distance that the market fell in will be replicated here in equal move. And that, as I just calculated out, is 86 S&P points. You add that from the starting line, which is the 3450 moving averages, you're going to be arriving at 2060 or so, 2062. End of story. Now, what's supporting the market at this point, which is important, is keep on monitoring, as I've pointed out to everyone during the day, monitoring the moving averages. These moving averages start to curl down, things are going to start getting bad. All right? These moving averages right now moving sideways. You'd like to start to see them starting to curl up. That supports any price movements down, right? Prices generally tend to bounce off the moving averages, so that's a good thing. However, if they start to curl down, then that's a bad thing. Because despite this massive Brexit crap that happened, the moving averages did not budge one single iota. You can see that right there. Very, very important. What's also positive in this picture is this yellow line, which is basically the 5-day SMA. The 5-day SMA cracked and then just moving up nicely. If you notice, today was actually a very powerful inflection day. Why? Because it retested the 34, didn't retest the 50. It retested the 34, retested this thin white line, which is the mid-Bollingers, and retested the yellow line, which is the 5 SMA. It retested this is a major meeting point known as an inflection point. Is it a coincidence that the market tested that and then reversed? Nope. That's just the way the machines do it. It might not be too clear for your naked eye, but I see it, and you guys can see it too. So this is important. So the line in the sand, if you want to look at it that way, is at this point, if you want to look at it from a standpoint, is 2076. Write it down somewhere. Want to give it a little leeway? Call it, I called it 2060 to 2070. As long as the market stays above 2060 to 2070, it is building an internal force to break out over this range. End of story. In the meantime, it'll do enough zigzags and volatility moves, to throw the to get you all dizzy. But as long as it stays above 2060 and hopefully holds above the 50 and the 34, then you should be biased long in the market. Below this level, you are on the bottom half of this trading range, which is between 2120 and 2026. And that means that, yeah, if you're biased, it doesn't mean we're going to completely break down, but it simply means that the market base is losing some juice below 2060. And it's kind of making plans because the markets are very, you guys know better than I do, all right? It never shows its real hand. Never. That's why I do what I need to do. Sometimes hedge a little bit, doesn't work. Have the longs in place. No one can sit here and tell me, exactly what the market's going to do 2 weeks from now. That's garbage. So the bottom line is, this is the trading range. It's a wide trading range. It's 100 points, roughly 700 Dow points, which translates into low 17,000 to 18,000. That's your trading range that the market generally will trade over a period of 30 days. In the meantime, we look for opportunities to do what we need to do. Now, so keep it simple. Look at the moving averages. Look to see the directional bias of the 5-day. For the traders, it's very important. Some people use the 9-day EMA. Fine, I use the 5-day EMA. It's right there. And go from there. And keep a close eye on what's happening on the STOs, which I do. And if I see the STOs really starting to cross down, that means the market's giving me an early signal that it wants to go lower. So we're watching this carefully too. Early signals can be gotten through the 1 hour, which shows that the market initially will ramp up, get overbought, and then decide to see what it needs to do. Resets are happening every hour, every 4 hours, and we know that. By now, you guys should know that like the back of your hand. On the 4-hour chart, it's overbought. And if it's planning to reset down here, you can rest assured that the market will pull back a good solid 100 points real fast. So on the 1 hour, it's a little bit more clear because it is showing you, as I had shown before, a consolidation channel, and you can just simply draw it yourself by drawing two lines which need to be there. That's it. And I showed this on the Periscope too. If you see a breakout over the consolidation channel, don't sit there counting the beads. All right? Move. Because if it breaks out, it's going to break out fast and it's going to move fast towards this level. Of course, there's resistance up here. You know, all that stuff. These are all supply points, right? Major sell points. So obviously they're there as resistance, but if it starts to gain steam, it'll just cut through this fast. For that to happen, we need the financials, we need the energy to participate, and we go from there. We'll see what happens. Here is something very important. This is a dangerous market. Okay? I don't care what anyone tells you. So in a dangerous market, you don't want to leave too many very long positions open. If you see some decent profits or profits that you feel comfortable with, take it. If you leave very large, or you're in your size very large, overnight positions out there, you're not going to sleep well at night. Because regardless of how fantastic the charting is and regardless of where the stows are and this and that and what the pattern symmetry is, you might wake up to the morning with the S&P 30 handles down. So you can always have some hedges, small, so that if things go completely off, at least you make money on those. Is it easy? Absolutely not. Anybody who tells you is lying. Is it that hard? Not really. Just keep positions small. Yes, you'll regret sometimes not having larger positions when things take off like Netflix and stuff like that. But that's just, you know, you have to be alert. So I want to just warn people on that, okay? Saying all that, we're not in a situation where everything is falling apart. However, there is one very worrisome sign about the market. That is the 10-year bond. Now, this is, I believe, happening for a technical reason, but let's see. The 10-year bond is literally, it's at 1 point, you just move the decimal point 1 over to the left. It's 1.35 or 1.36%. 1.36%. Wow. So all rates which are marked with on the 10-year correlate with the 10-year, whether it be mortgage rates, whether it be credit card rates, loan rates, all that type of stuff, are subsequently falling. But it's also indicating, at least at face value, that maybe the global economy is really going, excuse my French, in the shitter, and the cost of borrowing money is just going to collapse. So I don't know. All I know is a good amount of money from Europe, which are not going to be held hostage at zero interest rates, still want to lie in bed within our treasury market, and on the 10-year bond, they are getting 1.36%. That's still 1.36% versus getting zero on the other side, meaning in Europe. So global money might be kind of, you know, sitting there, just doesn't want to move. They feel comfortable. It's snug in the treasury market. You know, it's comfortable. It's warm. You know, so that could be one reason. Whatever you know, from what I can see here at these levels, and this had happened back in August of 2012 also, you generally have a situation, and listen to this carefully. I'm sure you've heard it, you know, maybe on the media if you guys are, some of you are passionate students of the market, is at this point, you get 1.367 on a 10-year government bond versus more than 2.5% on the S&P. The S&P yield, I'm just guesstimating at this point, Somebody can look this up for me while I'm doing this. The S&P yield is Nav, I'll address that in a minute. It's very simple. You go to settings and you just change it to histogram. That's it. Nav is getting all puzzled as to why his McClellan oscillator is showing a line instead of a histogram. You just have to change the settings. That's all. I'll show you in a minute. All right. So so the bottom line is that the S&P yield right now, I believe, is in excess of 2.5%. Apple itself pays what? 6%? What's Apple's yield? Let me check it out. No, Apple itself right now on an adjusted basis is paying 2.4%. 2.4%. So let's use Apple as a thing. So 2.5% you're getting by sitting on a growth company. And here you're sitting on the bond yields on the 10-year bond, and you are going to be making 1.37%. Okay? So if the difference between 1.37% and 2.5%, I'm doing this quickly, see if anyone can beat me to that. Tell me what a percentage difference is. Let's see how fast you guys are. I guess you guys are not that fast. Can somebody give me an answer?
Almost 1.14.
That's not my question. What is the percentage difference between 2.5 and 1.37%?
54%.
How much?
54.
You're just guessing.
No, I didn't. I punched in 1.37 over 2.51.
I'm getting
1.14.
1.14 what? I'm not asking you for the percentage difference. I'm asking you for the actual percentage, Marcus. Get it right. Percentage. How much more is 2.5 over 1.37?
Oh. Okay.
Yeah, 1.14 is just the differential, but it's not the. 1 second. I'm getting
1.14%.
No, you guys are all wrong, man. I'm getting 83%, okay? And I think I'm correct. Because this difference is this is simple percentages, okay? So 1.14% is the difference, right? But how much
83.21%.
What is it?
83.21%.
Thank you. That's what I've been getting, and that's how I get confused. Who said that?
This is Rocky.
Good, Rocky. I'll tell you one thing, and this I learned a long time ago. This had nothing to do with you guys. When I first started on Wall Street. Wall Street guys, especially guys who are, believe me, in the money management business and brokers, they couldn't do percentages even if I paid them. I used to bet like $10, $20 bills. Who could figure out percentages in their head faster? I won every single time. And today is a prime example. No offense, man. People still can't figure out the basic percentage. This 2.5% is 83% more you're making on your money from 1.37%. Do you guys understand that? If you don't understand it, then I'll have our friend Rocky here make you understand it. If you don't understand this, you're fucking up in trading. Excuse my French. I'm serious. Because to this day, in a lot of these webinars, I've asked percentages and people have no frigging clue. And they all want to be great traders. I know I'm being a little tough, but honestly, think about it for a minute here. You can't even tell me that 2.5% is 83% more than 1.37%. Guys, time to recalibrate, please. All right? So let's get back to it now that this lesson's learned. Did everyone understand why it's 83% or you didn't?
Sure, I did.
Huh?
I did, yeah.
Okay. The way you calculate it, simple, okay? 1.14% is the difference between these two. You take 1.14 and you divide it from the lower denominator, which is 1.37. You arrive at 0.83. What do you do with the 0.83? You multiply it by 100 in your head real fast, because it's a percentage, and you arrive at 83%. Bingo. That's how you do percentages. So I hope everyone got a basic lesson on how to do percentages. When a stock goes from 2 to 4, and I want quick answer, when a stock goes from 2 to 4, right? Do you make 100% or 200% on your money? Quick.
100%.
100%.
Thank you. At least on that one, you guys all passed. Okay. All right. Good. Now, so that's how. So what I'm getting at, this is a very important lesson. Not the percentage part that we're covered with. Okay. Now no one's ever going to forget. They'll be like, so you just look at the difference and you divide it by wherever you want to come to. Okay. So the bottom line is, if you invest, if you put money in a government bond, and this is reality of what's happening out there in the real world right now, in the real world of big money, not puny little money that we play with, okay, is they can make 83% more on their return, on a fixed income return, by buying a standard S&P 500 basket yielding 2.5%. I think that number is actually bigger. So if that's the case, based on the theory of the differential between the fixed income market and the stock market, because this is the stock market, this is the fixed income market, right? Why shouldn't stocks go higher? This is an argument that's made by people who have been doing this, real smart. And it's a very simple thing. It's not the only reason why stocks should go higher, but stocks in general, given where rates are right now, are not expensive. That's an argument that's being had. All the guys could be, oh, stocks are really expensive. The PE is this. There's no earning. Tell me something I don't know. So go after companies which make earnings, which are in a growth industry. So the bottom line is that when you have this type of discrepancy, and you don't see these too often in the world of investing, where you have an 83%, you can 83%, you can leverage 83% by buying stocks. You can make 83% more on your money or on your interest, right? By buying a basket of S&P 500 companies yielding 2.5%. Why the heck are you not going to buy stocks? So that's a very powerful argument to buy stocks. Doesn't mean all stocks. It means good companies. And a lot of fund managers scratching their heads and saying, yeah, that's what I need to do. You can buy dividend-paying stocks. You can buy boring stocks. You can buy all this. You don't need to buy like every high-growth momentum stock, stuff that we trade in a lot of the times. So this is an extremely critical factor happening in the markets right now. Now, can bond yields collapse down to 1%? I highly, highly doubt it. I think bond yields are going to find a home somewhere between 1.3 to 1.36% where we are right now. Why is this important to you and me? It is very important to you and me. Let me clear off the screen. Okay. It's because when bond yields do start to go higher, whether it be in 1 week or 2 weeks or 1 day or 2 days, there is so much money that's going to come out of the fixed income market that you guys won't even know like what hit you. So from a pattern symmetry standpoint, this is obviously a multi-year chart going back to 2009. In 2009, we had bond yields at 1.9%. And this was the bottom of the market, remember? March 9, 2009, S&P was 666. Okay? And now we are back to April, excuse me, sorry, I'm a little bit under the weather. So we are down to April of, November or whatever of early 2012 at this level. My gut tells me there is going to be a surge of bond yields are going to start to move, not spike, but start to move towards level of sanity. And level of sanity is roughly around 1.5%, 1.6%, 1.7%. And if that starts to happen, and it's a little blip, you won't even see it. It's like this. Imagine it goes to 1.9%. Excuse me. you're going to see a significant amount of money. Remember, bond yields rising mean bond prices are falling. You guys understand that by now, you know? So the bottom line is, if that happens, money's going to come out of the bond market into the stock market, and the stock market, just on a technical basis, can very easily break out of that range that I just explained to you and go up and retest the highs at 2134 S&P, 18,000, whatever we were at on the Dow, and make a new high. Just simply by a by a small section of the government bond market outflow. Trillions of dollars are sitting here into it. So keep an eye on the TNX. It's very important. We need bond yields higher. When I saw the TNX today down 6%, that's the yield. It's at 1.36%. So no wonder the market's in the red, aside from resets and all that stuff that I, keep on focusing on. I mean, it's like it's a risk-off day, even though nothing's really collapsing. Netflix up, Apple barely down 80 cents, Amazon's up, Priceline's up $8. So techs were actually pretty okay. So what does that tell you? Biotechs, believe it or not, were pretty okay today. What really hit the market today were financials and energy. So if you take those two components out, which we can, then the market actually did really well, did pretty well. So keep this in mind. This is a very important factor. When you start to see bond yields rising, the TNX is a measure of the bond yield, not bond prices. Then that's going to have a serious effect on the overall markets and the trading positions that we trade in. The other thing to keep in mind is the Japanese yen. That's a really ugly looking chart. That's a weekly chart. So let's go on the daily. Remember, the Japanese yen has to weaken versus the US dollar. This was a channel that I had drawn way back, if you guys all remember. And now we're below that. So we need to come back into it. So coming back into it means we have to go over 103.5. That's 103.5 yen versus the US dollar. Right now, $1 can buy only 101 yen as we speak right now. So we need to buy more yen. That's the reason for the risk trade. We need to get a weakening yen. This is a strengthening yen because it's giving you less yen for each US dollar. Now, let's look at this from a technical basis. Not that I want you to be a currency trader, but this matters to us. Is if you look at it, there's a positive divergence going on here. A nice one. When the stows were all the way down at 0, the yen was at, just go straight up on this axis, the yen was trading at 110. Yes, everyone see that? The yen is now down to 101, but look where the stows are. This, ladies and gentlemen, as I've explained many, many, many times, is known as a positive divergence. Period. When you have a positive divergence like that, it's telling you that within a reasonably short period of time, in the case of the currency market, it could be hours, it could be a couple of days, you are going to see a reflex bounce on the yen moving higher versus the dollar. That means that it's weakening versus the dollar. What would be optimal for the stock markets is the yen turns around, weakens to about 105 to the dollar, or 106, and God help us if we actually cross over these moving averages and go to 107, the market will be up 500 points in one day. But these are powerful moves. These are serious macro money, so it's not like something that just moves because somebody bought 10 shares of Tesla. Okay? So this you gotta keep that in mind. So this is something very important to keep in mind. Good. Now, I will answer a few questions. And, one other important reminder, a very important reminder. One thing that I told you guys is keep your positions reasonably tight. Don't be too small, but tight. If you see a runaway position where I'm putting acceleration phase and stuff like that, remember, I'm doing a lot of background on the work, obviously, to alert you guys on things that you guys might not be seeing. And sometimes you guys see things and I said, okay, let me take a look at it. And then I say, go ahead and do it. But a lot of the times I'm noticing a lot of things which so be very selective. This AGN is going to be up literally, the chart-wise at least, and without other stuff going on with the Teva, what is it called? Spin-off and stuff like that. These guys could easily get to 250 bucks. CMG looks pretty damn good. So there's a lot of different things, stock that we played the other day. I didn't hold it. I mean, we made money on it. That was STZ, Constellation Bands. We did very well on the earnings. Kept on running higher. So almost at 170 right now. Amazon wants to go to 735. So be tactical. Be tactical. Don't have large overnight positions. If you have profits running with it, I put my charts out there with all the parameters. Use those, because one of our new members today asked me, well, will you give it sell alert? Yes, I'll give a broad sell alert, but I'm not going to tell you, okay, sell exactly there, because right over that, if it crosses over, it's going to run another 3 points. So you have to watch it yourself. But my charts are very defined, and so you decide, okay, it got here, let's see what goes on. And yes, here's another very important thing. A lot of the times we all do it. We're all guilty of that. If things starts to move, it's like, boy, why didn't I buy it there? Too late. There's nothing too late. Technically speaking, if you're a robot, the word too late doesn't come into account. Because what happens is if it's going through a particular tactical breakout, well, what's too late? So you have to jump in at that point, even if you pay more. That's the standard stuff that a lot of momentum traders will tell you. You buy higher because it's going higher. There's an old saying in the business, right? It's not where you came from or where you're going. That's what matters. So if you keep on thinking where you came from is going to determine what your profits are, then you are in a world of pain. Now, it's easy to say, because if something's up $4 and then you're like, oh, man, what should I do? This and that. Consult the charts. Look at the ones I'm putting across. Look at your ones and move with it. Because whatever it is, because of these volatile type of markets that we're going in right now, and we have been in volatile markets through and through. We all know that. But the volatility is increasing. Things will happen real quick, real fast, and you blink, and if you're not in there, you're not going to make it. And if you have a decent profit, take it out. Sit back. Very important. That thing, I really have to make a solid point. So here's a chart of Amazon, right? A daily chart of Amazon. So somebody looks at it and goes, oh, man, Amazon can, if you look at the daily chart of Amazon, and let's try to keep our human emotions on the side here, all the way from this 400 level. What is it doing really? It's staying within this broad channel. Either it's trading above the midline of the channel, which I'll draw in a second, or it's touching the bottom end of the channel. This was BREXUT right here. And doing this. The Bollingers up here are somewhere in that 740 range. But look at the upper end of the channel where the stock can get to. It's going to happen in one day. In the case of Amazon, it's crazy stuff. What if they split the stock? The stock will be up 50 points in one day. So the bottom line is that it's going here. This is where Amazon is going to land up, one with the other. Well, if it completely breaks trend, falls below this channel, and then there's a gap here, and then it covers the gap at 622. Obviously, the trend that's a trend change. That means all of a sudden Jeff Bezos became stupid. The big fund managers are dumping him. Whatever the case may be, I doubt it. But that's where the stock is going. So if somebody's looking swing out, they're like, okay, the stock's got another 70 points in it. 70 points. It doesn't take much for Amazon to go up 10% from here, does it? Not really. If it really wants to move, the move from 728 to 825 is 10%. Right? This is a 10% move. Is it possible Amazon goes to the bottom upper end of the channel and once sort of zigzags its way up? Absolutely. So this is another chart, for example, that I track, where I'm monitoring many different things. I'm monitoring the stochastics too. Now let me show you one thing about the stochastics, and just a basic thing here. It's not always the zone you're in. It's also the shape. This is called a gaping mouth, okay? Look at these lines. These lines have giving us no indications whatsoever that they want to turn down immediately. These ones. They're telling us, I want to stay higher, and I'll probably go like this and frustrate the crap out of the bears while I grind myself up to 750 or more. If you see a sudden move down on the toes, that's a different story. That means it's going to do this. You know, it's just going to, and even when it does this, it's not like the stock crashes, it pulls back a little bit. But looking at the shape of the lines is equally important as in the zone that they're in. So just giving, you know, little tidbits of many, many different things that you can do to analyze charts. You don't need to be a rocket scientist. Trust me when I tell you that. You look at the volume too. Pretty damn. Capitulation volume. Look at these. And then all buyers. All buyers. So go ahead. Okay, there's a question coming through. Let me ask this. Okay, Tesla fell again after hours. Let's look at Tesla's chart and let's keep all the crash stories, over. Somebody, 1 second. And then the other question was on the SPX daily chart, the fast toes are overbought while the hourly chart is oversold. Which one better direction, SPX, for the short run? Always the hourly, like I explained before a few minutes ago. Always the hourly. The hourly, the 30-minute, those are short-term charts. They're the ones telling you what the market's going to do. Long term, just because overbought doesn't mean it's going to crash down. I explained all that a few minutes ago. It can stay overbought for a short period of time before it does a correction. Sometimes the correction can be 200 points and it's already oversold. We saw that happen right during the BREXUT crash. So on the short run, you want to look at the 1 hour charts, obviously. All right. Okay, so let's look at Tesla. Tesla looks great on my Algo HFT charts on the platform. And anyone interested, some of the newer members, I'll forward you some information if you want to subscribe to that service. It's the platform's unbelievable, unbelievable. I have a short video on my thing too, on the how to read the Algo HFT charts if somebody's using them. All right, I already saw something here which tells me this frigging stock's going higher. Okay, Tesla. First of all, let's look at some broad patterns, all right, on Tesla. You have a massive head. You have multiple left shoulders. You have a downtrend line all the way from 286 bucks, which was engaged and held. And the stock is sitting in, and the stock is right here. So unless we enter this 180 lower zone, this stock will go higher, period. Because this is like a flying wing. Look at that. Inverse head and shoulder, flying wing, whatever you call it, right? Look at that. You got that big V-shaped recovery that 99% of people missed. It's the ultimate buying opportunity. You got these multiple left shoulders, right shoulders, and the stock, from a bullish standpoint, wants to break out. Now, what does breakout mean? It's just going to go to $300? No. Breakout means, looking at the lines that I've drawn, is that it's going to test, this is the uptrend line from 141, here's your uptrend line. Stocks, high momentum stocks, generally speaking, want to test to see if they want to go, if they can get over the uptrend line. So over the uptrend line would be roughly, let's say 240. But right now, it could do a retest of the lower end of the uptrend line, which is 233, which it's gone there so many times, as recently as beginning of June. We have a 50 and a 34-day moving average, which is, after crossing down here, is now kind of starting to flatten. Does everyone see that? Let me zoom in. Hold on. My naked eye tells me there is absolutely nothing wrong with this chart. And don't mind me, I don't even care about Teslas. I just like trading the stock here and there. I've shorted the stock too a few times, if you guys remember. So saying all that, you've got a couple of important things going on here. I'll show it to people. One is this red candle. What is this candle called? I know some of my older members will probably know. What is the candle called? This one. Jimmy? Corey? Anyone?
It looks sort of like a hammer a little bit, doesn't it?
No, there's no hammer there. A hammer looks...
There's a little bit of wick on it.
Yeah,
There's a little bit of a wick.
Everything has a wick. Tell me a candle which doesn't have a wick. I'll tell you what a hammer is, okay? A hammer is something like this, like it go boom, and then the head of the wick is, it's up here like that, okay? This is basically a hollow candle, okay? Just the way there's a hollow candle here. If you notice, time to time, on certain events, especially on heavy-duty, rough days, you see a hollow candle reversal. I want to get into it too much. You guys can study on your hollow candle reversal off some pivotal bottoms, which this is not a pivotal bottom, but it's still positive. But hollow candle reversals are extremely powerful. What Tesla is basically doing right now, in my opinion, if it can take out the moving average, the 34 and the 50 at around the 219, 220 level, the stock will make an immediate run for 233. This is a high momentum stock. I don't need to tell anyone that. Okay? But there is nothing here that's telling me that the stock's about to crash. So regardless of whatever crash report and this comes out and that comes out, guys watching Harry Potter while he unfortunately crashes into a truck and dies, the fact is, it's hard to take a company like Tesla and completely demolish it because there's way too many things going on within that company. It's not just about the car. You got the gigabit factory. You got the whole solar move going on. So there's a lot of stuff going on. And I'm not going to sit here and defend it or murder it. Like, it's just whatever. Okay? But trying to really make any major big bets other than short-term quick shorts on Tesla is a loser's game. Just so remember that. Fund managers have gone out of business trying to short Tesla. And honestly speaking, these guys who are eternally dogmatic haters of Tesla, which there are a lot of them, and it's almost like a political thing. You hate them, or doesn't matter what they're saying, you hate him. Like Elon Musk is a complete scumbag. He's a complete, what is it? You read that a lot on different forums. Like he's a complete scoundrel. He's a fraud. Yeah, right. Okay, great. So the bottom line is that chart-wise, this stock looks like it wants to at least test the bottom end of this of this uptrend channel. God help us if it goes over this uptrend line. If it crosses over this uptrend line, this stock will make a move to 260 very fast. If it breaks below this downtrend line here of 190, it's broken it a few times. It's bounced back. But if it breaks, let's say 190, stays there for more than 2 or 3 days, and then breaks 180, you can nicely short the stock all the way down to 140. Because at that time, the selling pressure will be intense. Okay? But aside from that, with this hollow candle, and today was an inside day. That's the interesting part. Look at the side. This candle is engulfed within this large bullish wick, which was last Friday. So this stock, and God help us, the bears, the hardcore bears. I'm bearish on Tesla too at times, so it's not like, but I'm talking about the real haters of Tesla. If these lines start to cross, the 50 and the 34 start to cross, you better stay long Tesla and buy every little dip. All right, just letting you know, because this stock will move very fast, very quick, and try to recapture where it really collapsed from, the real supply point or the head zone, which was $260. So is it possible that this huge pattern gets completed? Absolutely possible. If Tesla comes out with one announcement tomorrow that they can actually keep up with the absolutely insane demand for their products, which was really that they can't make enough cars, right? That's what they said, that third quarter, they might miss the delivery times. But they've been doing that from day one. I'm not making excuses, but there's a good problem and a bad problem. A good problem is when somebody wants to buy your stuff that bad that you can't make enough, and a bad problem is when nobody wants to buy your stuff and you're making too much. Think common sense. So what was Tesla's thing? It was that, hey, we can't really keep up with the numbers coming out. We gotta. What if they come out with a headline saying, hey, Gigafactory, is fine, is rolling. Looks like we can keep up production and meet all the scheduled delivery times. Whoa, stock will be up $15 in 2 seconds. So think outside the box. Don't just think dogmatic. So this pattern, in my opinion, does get thing. However, below 190, 180, the stock starts to lose steam, and that would become a nice short opportunity back towards these levels here. And around 140, which is truly a line in the sand, okay, is a phenomenal buying opportunity for this stock. So that's Tesla's story.
Hey, Frank, I got a question.
Quick.
In the Trader's Almanac, what I posted the other day, it looks like July's one of the greatest months. We're getting into earnings season, which could be positive, but the negative could be, I'm just giving you a comment, is that we're in the silent period and that companies can't do their buyback until 72 hours after they release the
I know.
earnings.
I agree with you. July, generally speaking, you're absolutely right, is a solid month, okay? However, with so many different factors that are rocking the world markets, it could be two things. It could be a huge month because we already have gone through so much. Think about it, right? Or it could be that, it could be weaker than what we are thinking. Now, the two sides to what earnings will bring. If companies really start sounding sad and depressed about possible after effects of Brexit, if it goes through, remember that, fully goes through, and Britain totally disengages and renegotiates all their trade agreements with the rest of the world, all that stuff, which takes years, by the way. And if companies say, man, that's really going to hurt us and over the short term and stuff, this market's going to fall. Because at that point, they'll be just like, hold on a minute. We were just getting our footing, and then the Brits have to come ruin the party. So the point is that we don't know yet. So selectivity is the only way I can go. I can't really tell because I don't think earnings revisions. I'd like to see what the earnings analyst opinions are, revisions. If they're extremely bearish, that's a good sign. That means the company can basically move up the number just a little notch and bang. It can jump up, 10, 15, like you've seen so many times, $10, $15 after hours. But the overall estimates have to be extremely low. Certain companies, like food companies, stuff like your Chipotle, Corey, you track that well and you own. I think Chipotle is going to do fine this earnings. I think the stock is good for $500. You heard it here first. All right. So I'm dead serious.
I agree with
because
I agree with you.
like nobody cares about it anymore, which is good, which is exactly what you want to see in a company. And so here's the stock at 758, and here's the stock now. Now you can't, from a technical analysis standpoint, you can't start to analyze the stock. We're going to go through step 1, 2, 3, how I'd analyze this stock. Okay. So you can't say, oh, it was a 758. So what? You didn't have like E. coli worms sticking out of every burrito. I'm just kidding. So the point is that, so let's take all this out. It's very clear for the naked eye to see that we have a pretty large double bottom in place at around the 380 level. Yeah, maybe it slips a little bit below that. Big deal. But you can see that. If somebody's thinking months, not days, then you're starting to see this formation come into play. There you go. This white line is the 200-day moving average. This one. And that's at 516. So is it possible that the stock gets there? At or around or after earnings? Absolutely. Absolutely. Now, you got these moving averages here, the 50 and the 34. Kind of starting to flatten out. They're sloping down, but they're flattening out. They're not crashing like they were doing here. Here, the angle was like a 45-degree angle. Here, it's kind of starting to flatten out. So if you were looking at short term, you could be looking at the 50 and the 34 at around the 426 level and say, you know what, I'll trade this stock for $20. Every time it falls at 374, 380, $20. You can do that. because once it touches this, and it will, this is the daily chart, it's 426. And if it does break out over the 50 and the 34, let's say the 50-day moving average, you are going to see a slew of retail money and other very kind of old-fashioned technical guys saying, oh, it's above the 50-day moving average right now, let's go buy the stock. Come in. And that would bring the stock up to, again, that 475, 480 level. So this is another stock which could flourish well during earnings. Just looking at pure technical patterns. What are the chances that the stock goes below 370 and heads towards 300? In my opinion, I think so much of the bad news is in the stock. And unless people completely shun Chipotle and it becomes a yesterday story, which I highly doubt it is, okay, then that's a different story. So this is another great play to do it.
You know, Frank, this is a little bit like, if you remember when Apple crashed down to about 384, it sort of has that same kind of pattern.
Generally speaking, when stocks make these type of long bases, like they say, the longer the base, the higher it goes. So if you really think about it, this is the base that the stock's been creating for the last 6 months now, right? Yes, for the last 7 months, some last December. That's the base. And of course, these look like humongous moves, but that's the base that it's been creating. Anyone have any other stock that you want me to look at quickly? No? Okay. So I'll put this up. I got to run.
So someone said Google, they typed in.
Actually, hold on one second.
Typed in Google.
Oh, somebody said somebody typed in Netflix and Google. Yeah, let's take a look at them. Netflix is some big stuff going on, you know. It's so this was okay. So on a short-term basis, this is the channels that I'm following. All right. And if it, you know, burps up like it did today, you know, you got a couple of contracts that just went berserk up to 300%. Take it. I mean, don't look at a gift horse in the mouth. You know, it's just the way it is. So basically, on a short-term basis, this is the channel that the stock is following. All right. Fast-moving stock, so you're going to get mixed signals on the internals and stuff. So no worries about that. You know, it kind of like started to go up and then it pulled back a little bit. Really, it's not telling you much. Still deeply oversold. McLaren oscillator is still minus 540, which is nice buying territory. No question about that. Look down here. It was minus 700. It was an unbelievable buying opportunity. But whatever the case, you could see some nice green volume candles, big short covering. That means that, you know, the shorts really panicked at that point. New buyers came in. So these are the channels you got to really look at. If the stocks fall below, look, the 50 and the 34-day moving averages are trending nicely higher. Very decent, very well behaved. No question about it. Okay. You have the magenta thing that I use, and many of you new members, you can start using it. It's called the Darvas box. Very handy trading tool. It kind of puts an envelope around the levels that you can be trading at. Okay. So 50, the moving average on the 1 hour is, on the 50 SMA is 95. If I see it fall below 94, I start to visually look at the pattern. It won't look good, right? So if you can basically put yourself in the, you can say, hey, if the stock goes like this, then obviously, you know, it's not looking good. So I'd be careful below 95, 94, which is the 34-day moving average. 34 SMA on the 1 hour or the 50 SMA. These lines have to be pointing up as exactly the way it's doing. So this keeps you in the game. The channels put things into perspective, and you can see that. You can move them around a little bit. They're not perfect, mind you. So you can move them around a little bit, and you can say, okay, it went down here, so I'll move the line down here. This was the big burp, right? I think I put the trade alert like right around there, and then came the news. I'm like, what? You know, I didn't even see the news. I just saw the price jump. So this one, you could tell yourself, hey, 95, start getting worried. You know, don't try to short the stock too much between 97 and 95, because if this thing turns around and goes up like this, it'll just kill your short. So this is not a shortable stock right now, unless it breaks that 94, 95 level. It's moving nicely between this first channel. If it breaks up over the second channel, this is channel number 2, then you are then at that point trading in a 4-point band of 102 to 106. It's really as simple as that. Netflix likes to trade 4-point bands, and you can see that through these channels here. All right, so that's your short-term picture on the hourly charts. Now let's take a look on the daily. On the daily, move all these lines, or say hide lines, hide all trend lines. Okay, so let's take a look at Netflix's daily chart. Okay, pretty damn nice looking, and I'll tell you why. First, you have accelerating volume, old-fashioned. Look at this, acceleration volume. This was the 27th of June. If I showed you this chart and say, hey, tell me when was Brexit, I couldn't even see it. Yes, you can't even see Brexit on this chart because it didn't even friggin' collapse that much. So somebody mute their microphones, please. So you have a couple of things going on here, which is important. Acceleration volume, nice, we like that. You're starting to see a pattern develop, a defined double bottom at 87, and you have a nice double bottom pattern coming up with the upper end of that at 110. Somebody wants to swing the stock off the daily and not worry about intraday noises and all that. As long as this continues, you're going to at least get to 101, and you will complete the pattern at 110. And that is basically what it is. The depth is, if you want to look at if you want to look at it from a cup and handle perspective, you can see the stock at 101. You got the bottom at 87. That's 13 points. Sorry, 14 points. Everyone follow me so far? 14 points, right? There's an old rule of the thumb. If it breaks out over this cup, this one. Now, once it hits here, it can create a handle. So don't worry about that, okay? You can create a handle once it gets to 101. So it can fall like 2 points, just regular handle. But if it breaks out, there's an old way of calculating it is you look at the depth of the cup, that's 14 points, and you add that to 101. That brings us to 115, or up here on the stock. I don't know if you guys knew that. It works a lot. From the old days when they didn't have algos and stuff, it worked a lot more. In other words, you look at the depth of the cup, right? And then you add that to the breakout, and you arrived at a point where you went there. Okay. So anyway, looking at Netflix as we see it here, ladies and gentlemen. Okay, it is still a constructive chart. You can see that. We need a breakout over the 200-day moving average. That's a white line over 101, and we could very quickly see 110 real fast. This is positive. Internals are showing somewhat of an overbought condition. However, keep in mind, strong stocks tend to remain overbought. If this China stuff is somewhat true, they've hinted at it. If the Comcast stuff is true, that Comcast is going to allow Netflix to be on their platform, guys, today's move is going to look like baby food. All right, it's going to be big. That's it. I mean, it's one of those things. But there's nothing technically negative on this particular chart. Google next. Google's chart is a little bit more harder to dissect. So I am going to take all the lines out and look at Big Daddy Google in the form of a very large Darvas box, right? So if I showed you this Darvas box and I said, where do you think the stock's going to go? What does it look like? What does it look like?
But the potential is to go above 800, 810 or something.
No, looking at the short-term picture, there is something big going on here. Notice something really big going on. I'll give you a hint. It's the lines are magenta lines, and it looks like a.
It's a consolidation, 120-point consolidation box, basically.
Oh, 714, 712, 714.
Right. This is what this is something big about to happen on Google, okay? And I think my gut tells me it's going to be to the upside, purely because the stock, as you guys have correctly pointed out, is on the lower end of the trading scale, right? Not on the upper end, because the upper end of the scale is 810, the lower end is 680, the stock's at 714. When you see a bottleneck like this, ladies and gentlemen, it's the same thing as a pinched Bollinger, like I show a lot. If you notice, the pinched Bollingers, you have to find a directional bias for the pinched Bollinger, but my pinched Bollingers, depending on where they are, have worked out into significant profit for traders. So this one is a bottleneck. So message in a bottle tells me this bottleneck is going to be resolved to the upside. The gap, this is basically as who was that? Rocky, who said it's a 20-point band, right? 20-point band. What
Right.
is? Let me see here. To be exact, what is it? It's 712, 14-point band, right? 14-point band, roughly. So add 14 to this 713, the stock basically, you're looking at a retest minimum of the 50 and the 34-day moving average. Unless something is dramatically rotten within Google, this stock is going to bust a move within the next 5 trading days. Because personally, I haven't seen the daily chart on Google in a while now. This is the first time I'm seeing it. So I thank you guys for reminding me to look at it. Because this, when I see a bottleneck like this, given where we are with the stock, with the nice, this is the nice reversal hammer, even though it's in red right there. I would say the minimum move you can get on the stock is a good 20 points. And just from a tactical trading standpoint, forget about making long-term projections. Other way you can do it is we can draw a there. Okay. That also coincides with the 34. That's 721. That's a nice that's a nice doji, but more of a reversal doji. So it's good, similar to what we saw here. See this? See this? Very similar. This was a reversal hammer with the head at the top, the hammer head, right? This is more of a doji, but still, the closing price was on the upper end of the candle. A move over the mid Bollinger, which is 714, brings the stock into engagement with the downtrend line from 780. So this, looking even the shorter term picture here, is looking like it wants to bust a move on the higher end. Upper end of the Bollinger could be a possible magnet. That's 741. If we zoom back a little bit, on the weekly, if somebody wants to know, well, what do you think is happening in the weekly? It is, again, positive, because you have a massive reversal candle from June, and this is this week starting. This was the end of the Brexit and all that. It was a one fat candle. Love that. Nothing beats fat candles in green. All right, remember that. So then you have, sorry. So let's draw it from here. So from a swing standpoint, regardless of the intraday noise and all that stuff, upper end of the Darvis is 740, coincides with the same number that we looked at, which is 741. We need to cross over the these lines, they still haven't broken. Good sign. The 50 and the 34 weekly SMAs are still moving sideways. Retest of the 50 SMA on the weekly is 720. The 34 is 740. It always arrives at that 740 level. And a retest of this monstrous downtrend line is at 764. And of course, above that, see you later. Whichever the case, it's a possible, from a bullish standpoint, it's a possible dragon bullish formation or a W formation, which is getting played out right now. But on a weekly basis, your downside is capped at around 6, at around this level here. Your upside is obviously up at that 800 level. Risk reward wise, if somebody was looking at it from a mechanical standpoint, it's a favorable trade. That's it. But that doesn't mean it has that doesn't mean that it's not going to have wild swings. They all do. But I'm just giving you the perspective from a wider perspective of what it's doing, and that's why it's important to look at these things. It cuts out a lot of the noise that we incur on a daily basis. So, ladies and gentlemen, thank you for attending. Nav, Rocky, welcome to the club. And today we started off slow, and we still got some real fireworks. And tomorrow I'm going to be back in form. And like I said, there's a lot of stuff going on, and I can assure you that through actual proven methods, that we will identify them a lot faster than anyone out there. And there are people in here who will attest to that in a big way. All right? So stick out and stick with us. I know you've given a couple of referrals. I saw some free trials come in. Make sure they listen to this video cast. Make sure they participate in the webinars. Join as members. And remember, all content, especially for new members, just to know that, is delivered via the real-time Twitter feed, and the chat room is only for general discussion. Traders do tend to trade post some of their trades on the trading room chat room, but in general, it is just there for people to just discuss different things. It's not there to put physical trades in there. All right, it's going to be tricky, but like they say, just trade smart and stop, put that fear behind us a little bit, even though these are nervous times. I'll tell you, there's a lot of stuff going on overseas in Europe, which can affect us on a daily basis. So we have to be very, very cognizant. We have to be very alert. And my job is to try to pinpoint those things as quickly as possible. So on that note, I got to run because I'm already late.
Thank you, Frank.
Yeah. I'll see you guys tomorrow. Thank you for listening.